Welcome to a new version of a video that I'm rolling out in 2024, where I periodically do videos where I'm just focused on certain things that are really happening in the market. These are prepared more on an as-needed basis. In conjunction with these videos, each day I do a video, and I do a video each week. I do an Intermarket Analysis video each week, and then I do a thing called a deep dive video where I go through all the charts that I really didn't talk about and display them in a video by itself. The idea behind this is to show you what's really happening right now, and then if you want to get a bigger picture context of what's happening, go over and look at the daily, weekly, and intermarket analysis videos. This is being prepared for Monday, January 22nd, so this is time dependent. The first thing that I'm going to talk about are some positive things that should suggest that the market could go up from here. I'll give the list right here, then I'll show you the charts. Then I'm going to go through a negative list of things that we need to watch out for. The first thing is that yes, the S&P did set a new all-time high in Friday's session. It was the last holdout. It's also the broadest based index that we follow. The Dow had been setting new all-time highs and the NASDAQ 100 had been setting new all-time highs. We finally saw that confirmed in Friday's session. The technicals that we look at are positive. I use moving averages, I use oscillators, I use individual studies, and all of those are looking positive, but we're getting a little extreme positive in the short and intermediate term, and I go through that in the daily videos. We're also keeping an eye on growth to value. When growth is outperforming value, that tends to mean the market is going up. When value outperforms growth, that tends to put some pressure on the indexes. Lately, we've been seeing a real improvement in growth, and I'll show you that. We've also been following the 20-period moving averages. There's two different 20-period moving averages that I follow. We have been coming down to those points a couple of times in 2024, and we've been able to bounce up off of them, and that's short-term support, and so far that is holding. We also have some long-term trends that we've been looking at. This includes a long-term trend for the S&P 500 and the NASDAQ 100, and so far that is holding up. We also look at another long-term study based on the NYSE new highs minus the new lows. For most of 2022 and a lot of 2023, this was negative. When we started to come back up last October in 2023, we started to see this indicator turn more positive, and so far it's remaining positive, and that's longer-term positive. We're also keeping an eye on sentiment. This is how is the market feeling about things. And right now we're in a positive area without being too extreme positive. The first chart is an intraday chart showing large cap growth in blue with large cap value. And we had been seeing some real weakness here at the beginning of 2024, where the blue line was going down as the red line was going sideways. That means that value was outperforming growth. Then about the 8th of January or so, we started to see the blue line begin to go back up and the red line start to come down. Finally, they crossed, even though they're on different scales. And when we see the blue line above the red line, that's more positive. So this is one thing that we've been watching closely to suggest that the market is looking more healthy. We also look at a growth to value ratio just for the S&P itself. It also bottomed out at about the 8th of January and has since been showing a lot of improvement. So this is positive. Then we look at some end of day charts. The first area is small cap growth to small cap value. This has been chopping more or less sideways, and right now we're getting near the upper end of this range. As the index was going up, we were chopping sideways with this ratio. We want to see this ratio really going up as the index is going up. As we were coming down, we were seeing some real weakness with the growth to value ratio for the small caps, and we're supposed to be going through a thing called the January effect right now. It seems like it was the December effect, at least this time, where we saw small caps doing really well in December, and then we get into 2024 and they've been under a lot of pressure, although they did bounce back in Thursday and Friday's session last week. We also keep an eye on mid-cap growth of value, and this is looking a little stronger. When the index was going up, we were seeing this ratio more or less going up too, and it's also in a longer-term uptrend. We're also breaking out above this recent range as well. So as long as this continues to go up, that should give some support to the mid caps. Now, if this starts to go down, that might help put mid caps under pressure. Then we look at an end of day chart with S&P growth to value, and this had been showing a negative divergence. When we were going up from the October lows into the end of the year, we were seeing a negative divergence as the growth to value ratio was actually going down. now we're starting to see some improvement here. And as long as this keeps going up, that could be more positive. Then we look at another growth to value study, and we use a rainbow chart here where this is looking more positive. We're going up and we're breaking out above this previous range, and we're above all the lines in the rainbow, even though we haven't come back to the all-time high set with this ratio previously. But this is showing some signs of improvement. Then we look at the 20-period moving averages, and I plot a simple moving average and an exponential moving average. The debate goes back and forth which one is best. A simple moving average takes all 20 periods and they're all treated the same. An exponential moving average weights it closer to more recent prices. In order to avoid the debate about which one's better, I plot them both, and we can get some insight just from this chart. When the blue line is above the red line, that means the exponential moving average is moving faster than the simple moving average, which it tends to do, and that suggests that the shorter term trend is more positive. When it drops below, we see some weakness starting to develop. What we saw at the beginning of 2024 is we came down right to the simple and exponential moving averages, and we were able to bounce up off of that. Then this past week, it looked like we were turning more negative. We held on to the exponential moving average, and now we're starting to bounce up off of that. This would turn even more positive if the blue line could get back above the red line. Then we look at a long-term chart. This is a weekly chart of the S&P, and this is a trend line going all the way back to the 1987 crash. And right now, we're still above this longer-term trend line, so that is positive. We confirmed that with the NASDAQ 100 going back to the low set in 2009, and we're starting to break above this longer-term trend line as well, and that's also positive. Then we look at a longer-term study. This is the NYSE new highs minus the new lows. On top is the S&P 500. So we have an index on the top and then a broader market measure down below. What I've done here is the new highs and new lows are on this chart, but I've changed it over to invisible. On top of that, I have a 50-period exponential moving average. And we spent a lot of 2022 and even a large amount of 2023 below zero. We would peak our head up above it and then fall back down. Peak above, fall back down. Now we're starting to come back above this level. The longer we can stay above this, the more positive in the long term the market will be. Then we also keep an eye on sentiment, and we had become extreme positive. When we get above 75, that's when we start to use this as a contrarian indicator, meaning the market's getting a little too exuberant. Well, that's the way things were at the end of December 2023. Then as we started to go down, we saw sentiment start to go down and then back up and then down. And now it's showing some improvement, and we're not necessarily extreme right now. If we get up above 75, that's when we'll start to look at using this as a contrarian indicator. And I go through this every day in the daily video. Then some negative signs that we need to be aware of. Interest rates are rising. And we saw something interesting in Thursday and Friday's session. Stocks were up and interest rates were also up. In this type of an environment that we've been in with the Fed raising rates, possibly done raising rates, and at some point maybe even cutting rates, stocks are really sensitive to what's happening with interest rates right now, and they have a tendency to go in opposite directions. We saw them going in the same direction on Thursday and Friday, and there are some concerns that are starting to develop, not necessarily that we're turning negative, but just things that we want to keep an eye on. Discretionary, which is another area of growth, it has been really underperforming. We compared discretionary to staples. Discretionary are the things that make life interesting and life fun, but you don't necessarily have to have those things. Where you compare them to staples, the things that you have to have no matter what's going on in the economy. In a stronger environment, we want to see discretionary outperforming staples, and it has not been doing that. Then we have a 200-period and a 50-period simple moving average study. These are starting to roll over and decline, even though they bounced up in Thursday and Friday's session. They were extreme positive. Now we're wondering, is this the beginning of a decline, or are we going to be able to bounce up from here? And this is another longer-term negative divergence that we're seeing. The Dow is setting all-time highs, but it's not being confirmed by the transports, either when we look at the Dow or the S&P 500. Small caps are underperforming. We were supposed to be going through the January effect, but we did in December, but so far in 2024, we have not been seeing that happen. And then the dollar has been rebounding over the last week or two after it had been in a decline. That often puts pressure on stocks when the dollar is going up, and it gives support to stocks when it's going down. So the first chart, we have the S&P on top, and then we have an equal weight discretionary ETF, where this had been in an uptrend, but since has been falling back. We also have a staples equal weight ETF where it had been declining and starting to bounce back up as well. The important part is on the bottom. This is the ratio between the two. And when we were moving up earlier on, this was going up higher, and that was helping to produce more support for stocks to go higher as well. But then we get into 2024 and we're seeing this ratio really start to go down compared to the S&P going back and making all-time highs. Now, this can be rectified. We just want to see this ratio continue to go up, and that would turn us more positive. For right now, it's a slight negative divergence. Then we look at a 200-period moving average study and a 50-period moving average study. In late 2023, we got extreme with both studies on top. That's where I have the blue line here. And now we're starting to come back down with both. We are ticking back up after Thursday and Friday's session, but we want to watch this to see, is this going to continue to decline? That would be more negative. If this can turn and go back up, that would be more positive. Then we're seeing the negative divergence between the Dow, which is setting all-time highs, and the transports, which can't even get back to this previous high, let alone an all-time high. And that's longer-term negative. When the transports are really doing well and going up, that tends to give more support to the S&P. Then I also include utilities on the bottom as part of Dow theory, but it's not necessarily what I'm talking about here. This is a ratio between the transports and the S&P 500. When this is going up, that means the transports are outperforming. And you can see earlier in 2023, when this was going up, that really gave good support to the S&P. But as we were going up at the end of 2023, this ratio more or less was going down, and that's putting some pressure on stocks. Doesn't mean things are going to turn on a dime. This is just something that we want to keep an eye on. And we also look at the relationship between the two, where the S&P has been going up nicely, where the transports have been going down to sideways. And then on the bottom, we measure the correlation between them. Are they going in the same general direction at the same time or in different directions? They're showing some improvement now where they had been going actually in opposite directions of each other. And that's not surprising. We're seeing the S&P going up as the transports have been sideways to down. If this gets stronger and the transport shows some more improvement, that will be more positive for the market. Then we look at the small caps to S&P 500 ratio, where it had been in a decline for a lot of 2023, which is okay because the mega caps are the ones that really have been outperforming. Then we got into the latter part of 2023 and we saw this ratio start to go up. Now, since 2024 started, this ratio has been going down. In a good solid environment, we want to see the small caps participating with the other indexes at the same time. Then we look at the US dollar index on a daily chart, where the dollar had been stronger in 2023. That's when stocks were under pressure. Then when the dollar started to decline, that's when stocks were going up. Now we're seeing a bit of a bounce here, but we did generate a death cross with this trend not so long ago. If we can continue to go up with the dollar, that may negate this death cross and turn it back into a golden cross. But for right now, the downtrend is still intact. And if we continue to fall, that may give more support to stocks. Then I'm taking a look at some bond studies. When I'm looking at 1 to 3 year bonds and 3 to 7 year bonds, and there's some logic that we need to apply here. If you're worried about interest rates going up, you want to get into shorter term bonds because they mature faster, and the next time you go to mature, you could probably renew that at a higher interest rate. So when interest rates are going up, the 1 to 3 year outperforms the 3 to 7 year. Well, then we hit the summer months and the market was trying to go with this idea that maybe the Fed was done raising rates. And so we started to see this ratio go down. Then things kind of got ugly and we hit a high in July of 2023. And then this ratio started to go back up, meaning that folks were getting more concerned about interest rates. Then when we hit the low in October, we started to see this ratio coming down as stocks were going up. But lately in 2024, we're starting to see this ratio go back up. We want to keep an eye on this. If this continues to go up, that could put some pressure on stocks. This next chart is an inverse of that same idea where we compare 7 to 10 year bonds with 3 to 7 year bonds. When this is going down, folks are favoring shorter term maturities. When this is going up, they're favoring longer term maturities. And think about that. If you think interest rates have topped out and are going to start to go down, you want to get as long of a maturity as you can to lock in that yield for as long as possible if you think interest rates aren't going to go any higher than that. And we saw this starting to go back up as stocks were going up. Lately, we've been seeing this ratio coming back down as there's some uncertainty about what the Fed's going to do with interest rates. Then we look at a 1 to 3 month T-bill, which you could pretty much call cash, and we compare that with 3 to 7 year bonds. When this is going up, that means that cash is actually outperforming bonds, believe it or not. And there's a real amount of uncertainty about interest rates, and this is called a risk-off type of stance. And we started to fall back, and we were showing some improvement in late spring, early summer, but then everything started to shift, and this ratio started to go back up. Then when we hit the bottom in October, this started to come down, and now this is starting to go back up as well. So this is confirming what we're seeing in the previous charts. Then we look at a thing called TIPS. These are Treasury Inflation Protected Securities. These are shorter term, and they also adjust based on interest rates, and so you can roll them over into a higher interest rate. If you think interest rates are going to keep going up and up and up, that's when you get into TIPS, and that's when we see this ratio going up. Then we started to go sideways to down as they thought maybe interest rates and inflation are under control, but then over the summer months, we saw this ratio going back up. Then we hit the low in October. This ratio started to go down, but now it's starting to go back up again. So just a warning sign that we want to keep an eye on. And I go over this in the daily videos. But on a positive side here, even in the negative slide area, we look at home construction, which is very interest rate sensitive, and we compare it with bonds, and we see that this ratio is going up, meaning that home construction is not really worried about interest rates. So this is more positive for right now. If this can continue to go up, that might help give the market some support. Thank you. I hope you found this helpful. Please feel free to check out the videos that I post each day. I have a weekly video, the Intermarket Analysis video, and the deep dive video. Have a great day, and I will talk to you in the next video.